Welcome back to Morning Trade Live. I'm Oliver Renick. It is market meetup time. We've got Steve Rashis in studio, the Chief Options Strategist at M1 Capital Management, and Scott Bauer. We got double guests here, the CEO of Prosper Trading Academy, also, and sandwiched in the middle, Stephanie Lewicki, Senior Manager of Futures and Forex. Steph, you want to get us started on retail? Because we've been talking about this a lot. How big was this holiday season going to be? The numbers that I see, they look pretty big.
Yes, the numbers that I see too, according to MasterCard, so they grew at 5.1%, the best season in the past 6 years. So holiday sales really good this year. Also, a couple other numbers that went along with that is online sales were up 19.1%. Department store sales did fall, but online sales for those department stores were up 10.2%, and then apparel and home builder were the two best out of the retail. Those percentages were the highest, with toys actually being one of the weakest, which I was surprised by that one. But a really good season for holiday sales, with Amazon having record numbers as well.
This is really interesting stuff. There's a lot in here to break out. The overall, let's start with the big macro number, all right? The overall macro number is big, okay? You've got the holiday sales online, according to MasterCard, up 19%, as you mentioned. The 5.1%, the growth rate a little bit better than even last year, which was the best since 2011. So essentially, Steve, what we're getting here is a sign that our consumer is either not looking at the market or is got a little extra cash in their pocket or something, but they're spending. Shouldn't that be a good thing?
Well, I guess. I think right now that's sort of, you know, the macro political picture far outweighs any of the economic data points. You know, so obviously it's a good thing. You know, you've seen a strong spending season during the holidays. That's fine.
That's spending, you know, two-thirds of the economy comes from consumers.
Okay, that's all wonderful. But I just don't think that it's going to have the impact now until some of these really severe stress points get removed.
Okay, so impact to what? Sorry to jump in, but impact meaning to risk assets like the stock market?
Yeah, I mean, basically, if you really look at what's happened, you know, in a month plus time, you had a 2-year reset of valuations between the S&P, NASDAQ, Russell, and the rest of the world markets, you know, emerging markets, European markets. There was a huge disparity for a long time where you know, the S&P, the NASDAQ, and the Russell were significantly outperforming the rest of the world. And basically that unwound this quarter, you know, quickly. So, you know, I think that's the bigger picture, is that there are too many big stress points in the markets for the individual data points to really matter. Obviously, if they stay strong, that's good. Okay, but you know, that's the past.
You're saying it's going to take more, basically.
Yeah, absolutely.
So Steve looks at this chart and says, look, this is not down because the retail was slow and now retail's back, so everything is all good, Scott. But it can't hurt, right, to know that consumers are at least comfortable spending money, are going to go do it at the time of year to spend money, just when this market is getting concerned about things like consumer health, things like the economy?
So I'm going to talk to both of your points there. Steve, I agree with you that there are so many stress points. The risk headline is still just as great as it was before the Fed decision. It really is. That being said, the underpinnings to this market, the economic numbers to this marketplace are still solid. They're not as robust as they were 6 or 9 months ago, but still extremely solid. And the way the consumer spent over the last 6 weeks or so really speaks volumes. It does. Now, how does that translate into what the overall market is going to do? That's a big question, because even though we had these blowout numbers, which is great from the consumer side of things, I'm not so sure that when these retailers actually report, that they're going to report great numbers to the bottom line.
Is that about margins? Is it about how much they had to spend, inventory, stuff like that?
It's about how much they had to spend, and it's about margin. Okay. Now, so you have both sides.
Very fair point.
You have both sides of the equation there. Great thing that the consumers are spending. On the other side, I don't think the margins were there. So what does that mean for the marketplace? Well, I think you still have to look at the longer term, more fundamental picture, look at the economic numbers here, and really see what the consumer is doing. And I think it's a positive.
So, and still, just to add into that, lowest unemployment at 3.7%, wage increases, minimum wage hiked at a lot of the retailers, so I think people had extra money in their pockets to actually spend, and then also with crude being down more than 20% on the year, that acts like a tax cut as well, so they did have some extra money in their pocket.
I heard so much about oil, or rather gasoline, this past week that people, when I got a ride out to Virginia from D.C. to visit the family, the Uber driver was looking at 250 and it was like, I got to stop here and fill up the tank. So it's a real input. What's interesting that you mentioned there about the price, or rather the wage hikes, that goes right into what Scott's just talking about, which is that even though there's an overall spend happening in the holiday season, companies that then also had to spend more for employees, that had to spend more to compete in a competitive environment, it's going to be basically a case by case for stocks.
Yeah, so like you said, let's wait to see what they report for earnings, which start in 2 weeks, and see what their numbers are there.
Yeah. Steve, do you want to have exposure to a consumer-driven company, a retail and apparel stock, a clothing company, something like that right now?
I think you have to take it as a case-by-case basis and see where the valuations and pricing is.
Okay.
I mean, I don't think, like, I don't look at things in a way to say, well, this is a blanket statement you can say about the industry. I think it's company specific. I think there are going to be winners and losers, you know, and everybody has to remember that the more expensive things get, if they have a robust sales period, that offsets, you know. So you have to take it case by case, look at each individual stock, see what their fundamentals are, and they're, you know, you got to buy the strong ones and get out of the weak ones.
Sure. If we bring up XRT, the retail ETF, it's not the best proxy. It's got stuff in there as well. You know, like the Netflix is always the caveat when we talk about this. But Scott, when you look at it, it's been just trounced, okay? And it wasn't like that originally. It was funny because when the market started first turning over in October, Macy's, Kohl's, a lot of the companies were actually in the apparel side were doing pretty well. They were hung in there until basically everything dropped off. Right. So when you look at these, basically, if consumers spend and they go and buy their products, if you go and buy a bunch of Urban Outfitters clothes, that stock should show good earnings numbers when it comes out. What about your case here for company specific? Do you want to try and go in and dabble and pick the companies that do this right, that are going to pick up all this cash flow?
You do have to be very company specific, and I like the retailers coming out of this season, the very specialized retailers, not the Macy's, not necessarily the Kohl's, even though I love Kohl's. I love these retailers that people still shopped, they spent their money there.
So not the big box ones.
Not the big box, but people that spent their money at places that didn't have to reduce 70%, didn't have to mark down 60%, didn't have to load up their inventory. Maybe a stock like a Lululemon.
Yeah.
Something like that that is very specialized that I believe are going to show just fantastic numbers. On a side note here, I just got back from a mini vacation out of the States.
Good.
Talking to a bunch of the retailers in a very, let's say, robust area for travelers.
In the mystery area? Can you tell us, Mr. Bauer?
In the Caribbean somewhere, in Aruba. Okay. So I went down there to spend some of my money, and some of these retailers were telling me they have not had a Christmas season like this with Americans,
powerful?
With Americans coming in and spending as freely.
Well, think about our dollar,
they can
right?
remember.
Yeah.
So that's actually a really interesting point. I wonder how much of that spend will also go abroad with the strong dollar.
Yeah.
And by the way, since we talk about stocks all the time, I was doing the same thing, walking around New York, looking into every store. All right, how's that, Urban Outfitters doing? What do we find? Did anybody, which stores were popping? Stephanie, any big takeaways?
Canada Goose is doing well. I did not buy myself a Canada Goose, nor did any of my relatives get a Canada Goose. But I did most of my shopping online, as Amazon had a good quarter. There wasn't a Toys R Us. I have small kids again. There wasn't a Toys R Us to go to, but I did most of it. Target, Amazon, and so I actually really didn't go into a brick and mortar store, believe it or not.
All right, we're going to take a short break. We'll be right back. We're going to talk about growth and the importance of it. Goldman cutting its forecast just when investors are starting to get worried about the economic situation. This on the back of some interesting tariff news this morning. Stick around, we'll be right back.